Silver didn't creep past $100. It exploded through it. And that matters, because markets aren't supposed to move like this. Not silver, not now, not at this speed. Yet the move from 90 to 100 took just 10 days, while an earlier move of the same size once took nearly 5 months. That contradiction is the story. And if you think this is just about metals traders or charts on a screen, it isn't. This shift reaches directly into currencies, savings, supply chains, and the rules that quietly decide what your money can still buy. On paper, silver crossed a psychological level. In reality, the pricing system itself started behaving differently. Dealers can't keep showcases filled. Refiners are delaying payments. Governments are repricing products as if the old numbers no longer apply. And instead of slowing things down, higher prices are pulling in more buyers, not fewer. But here's the part nobody is saying out loud yet. Once a market stops respecting its own resistance levels, it stops playing by familiar rules. And what comes next is where this gets uncomfortable. The core event here isn't just that silver crossed $100. It's how it did it, and what that speed signals. According to the data you provided, the move from 90 to 100 happened in 10 days. Earlier in this cycle, a comparable $20 to $30 move took 145 days. That compression alone reframes everything. Markets don't accelerate like that unless something underneath them breaks. And notice, we're only seeing part of the picture. Public attention is fixed on the price tag, but the price is just the surface effect. Underneath it sits a shift from linear movement to what the analysis calls a parabolic trajectory, where resistance levels stop functioning and momentum feeds on itself. The model being discussed no longer treats a move to 150 as a long-term projection, but as something measured in weeks. This isn't being framed as an isolated spike. It's being treated as a phase change, a transition from technical trading into scarcity-driven price discovery, fueled by physical constraints and panic behavior. Here's the reframing question that changes how you see it. If price is accelerating because the system can't absorb demand anymore, what happens when the next constraint fails? The strong claim being made is this: silver is no longer being priced by normal market mechanics, and the evidence is concrete. The analysis points out that once the $100 level was breached, the market showed an inability to consolidate at the $100 level. That matters because consolidation is how markets breathe. When it doesn't happen, something else is in control. Look at the timeline. The move from $90 to $100 took 10 days. By contrast, the earlier climb from $20 to $30 took 145 days. That isn't enthusiasm. That's a collapse in resistance. The text describes it as a melt-up dynamic, where capital inflows overwhelm every traditional sell zone. Instead of profit-taking, higher prices are creating faster appreciation. And here's a detail that changes how you interpret the move. The analysis explicitly states that volatility is expanding to the upside. Normally, volatility invites selling. Here, it's doing the opposite. Higher volatility is reinforcing buying behavior, creating a feedback loop where price appreciation accelerates instead of correcting. Now notice what's missing. There's no mention of a technical ceiling, no emphasis on overbought conditions, no expectation of stabilization. The explanation given isn't speculative mania alone, but acute physical scarcity and panic buying overriding paper signals. This is where the story flips. If price is no longer constrained by technical resistance, then the next move isn't about charts. What makes this more dangerous is how fast abnormal behavior is becoming normal. According to the analysis, the market hasn't just accelerated, it has stopped pausing altogether. Resistance levels that once slowed silver for months are now being erased in days. That's escalation, not enthusiasm. There's a quiet precedent here. In 1979, silver rose 434% in a single year. At the time, it was considered unfathomable. Now, the text explicitly notes that similar gains are being modeled as statistically plausible in the current cycle. Not because investors are smarter, but because the system underneath the market is thinner, faster, and far more fragile. What used to be extraordinary behavior is being absorbed as routine. A $10 weekly move is no longer shocking. Dealers aren't asking if prices will pull back. They're asking if they'll be able to restock at all. The market has shifted from negotiation to momentum. Here's the normalization that should make you pause. Instead of consolidation at $100, the analysis describes immediate continuation. No breathing, no reset, just forward motion. This is how escalation hides in plain sight. When the market stops asking for permission to go higher, what's left to slow it down? The second proof hit is more unsettling because it shows the system failing at the physical level, not the price level. The analysis states that major refiners have stopped purchasing junk silver and sterling silver altogether, or are delaying payments anywhere from 10 days to 3 months. That single detail changes everything. Here's why. Bullion dealers survive on velocity. They buy, refine, resell, and redeploy capital in a tight loop. But when refiners won't pay on time, that loop breaks. Dealers are sitting on metal they can't convert into cash, even as spot prices hit records. The text describes this as a severe liquidity crisis, not because silver is unwanted, but because the infrastructure can't process it fast enough. Notice the contradiction. Silver is over $100 an ounce, yet entire categories of silver are becoming illiquid at the wholesale level. Refiners will still accept pure 0.999 fine bars and kilos, but alloyed metal is effectively frozen. That creates a bifurcated market where not all silver is treated as silver anymore. This is the line that permanently reframes the issue. A market can survive high prices. It cannot survive a seized conversion mechanism. When the pathway from physical metal to deployable capital clogs, supply doesn't just tighten, it disappears. And once that happens, price becomes a lagging indicator. Now the pressure starts stacking, fast. The analysis describes multiple stress points hitting at once, not sequentially. First, dealers are buying 6 figures of inventory daily, yet showcases remain empty. That means supply is being stripped faster than it can even appear. Second, refiners are delaying payouts, freezing dealer liquidity right when demand is peaking. Third, retail buyers are entering with no price sensitivity at all. This is where speed replaces strategy. Buyers aren't asking what silver is worth. They're asking whether they'll still be able to get it. The text describes a whole new universe of participants entering purely because price is rising. That's not value investing. That's panic participation. At the same time, long-term holders aren't selling. They see $100 not as an exit, but as vindication. The analysis notes that stackers are holding tighter, not lighter, further shrinking available float. So you have new demand surging in, old supply refusing to come out, and infrastructure choking in between. Everything is happening at once. No cool down, no release valve. This is the moment where markets usually regain control. But here's the question hanging in the air. At this point, it stops being abstract and starts landing in real life. Because when a market behaves like this, you don't experience it as a chart. You experience it as friction. You walk into a shop and there's nothing in the case. You're told to wait. Or worse, you're told the price is good for the next 5 minutes, not the next day. According to the analysis, buyers aren't hesitating over premiums or record nominal prices. They're buying to participate, not to optimize. And that changes how this hits ordinary people. If you're trying to protect savings, you're now competing with panic, with institutional flows, and with a system that can't restock fast enough. If you're late, you're not just paying more. You may not get access at all. There's also a quieter pressure building, the desire to move outside the monitored financial system. The analysis references buyers deliberately navigating reporting thresholds, splitting purchases, traveling across jurisdictions. That's not speculation. That's behavioral adaptation. This isn't ideology. It's response. When access tightens and trust thins, people adjust. If this feels familiar, say so in the comments, because the pattern doesn't stop here. To understand why this keeps happening, you have to step back from the emotion and look at the mechanism. This isn't chaos. It's incentives colliding. The analysis makes it clear that silver isn't moving because everyone suddenly agreed on a new fair value. It's moving because multiple systems now reward the same behavior at the same time. Scarcity rewards holding. Volatility rewards speed. Geopolitical uncertainty rewards insurance. And financial surveillance rewards exit. None of these incentives require coordination. They simply stack. When they do, price stops being a signal and becomes a byproduct. Here's the unsettling insight. The system isn't designed to absorb a rush toward physical assets. It's designed to discourage it through friction, delays, and complexity. When those frictions appear during a panic instead of before it, they amplify demand rather than slow it. This is why higher prices aren't cooling the market. They're validating the decision to buy. The analysis shows that once participants believe the currency is weakening structurally, they stop asking what silver costs and start asking what it replaces. And that's why this feels smarter than the headlines. Because the story isn't silver. It's what happens when trust quietly expires before policy can react. The next move isn't theoretical anymore. From here, the trajectory splits, but neither path looks calm. The analysis outlines two futures forming at the same time. In the first, momentum feeds on itself. Silver continues higher as physical scarcity worsens. Eastern markets maintain premiums, and Western prices chase to prevent inventory drain. In that scenario, $100 isn't remembered as a peak. It's remembered as the floor where behavior changed. In the second path, pressure doesn't release through price. It releases through control. Regulatory friction increases. Taxes, reporting thresholds, and restrictions expand. Liquidity is forced back into monitored channels. That doesn't collapse demand. It redirects it, geographically and structurally. Capital flows toward jurisdictions and instruments that still allow movement. Notice what's missing from both paths. A clean reset. There's no scenario presented where silver simply drifts back to 50 and everyone exhales. The analysis explicitly frames retracement as unlikely. Not because prices can't fall, but because the drivers underneath them haven't reversed. This is where uncertainty becomes momentum. Every delay, every premium, every policy response feeds the same conclusion. The next move is already forming, and it won't announce itself politely. Here's the insight that ties it all together. Silver didn't break $100 because it became more valuable. It broke $100 because the measuring stick became less reliable. What you're watching isn't a commodity rally. It's a repricing of trust. Supply chains are seizing, refiners are delaying, governments are preemptively repricing. Shorts have vanished. Eastern markets are leading. Retail is panicking. Long-term holders are locking supply away. Every layer points in the same direction. The deeper pattern is this. When too many systems fail at once, price stops being negotiated and starts being discovered. And discovery is always violent. That's why this story doesn't end at 100 or 150 or 200. Those are just numbers we recognize. The real shift is behavioral, and behavior doesn't snap back quickly. This is only one layer of a much larger realignment. And in the next analysis, we'll dig into where capital goes after silver stops being the shock absorber. If you want to stay ahead of that curve, follow and subscribe for what comes next.